You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? Mike from The Moose on the Loose. I hope you're doing well today, and I hope that you are actually doing better than OpenText. Is it the end for OpenText? Like that darling where probably one of the most interesting Canadian dividend stock in the information technology sector. For a long while, it was growing at an incredible pace. So aggressive growth by acquisition between 2010 and 2020, the stock price kept on rising. But right before the pandemic, the stock price was trading slightly below $60. And today, the stock price is around $40, like between 40, 45. Quite volatile company is stock price though. In October of 2022, the stock price was $35. Then it went up to all the way up to like $55. In 23, and then going back down to $41. So is it the end? Is it the end in the sense where do you think that this company will be able to pull it off one more and become again this super high growth, super powered technology company, or it's just the end of this, and now it has become a mature business offering you a decent yield, 3.5% yield, market cap of $11 billion. So definitely not a small player, but there's still a lot of room, right? But I was looking over the past few quarters and I'm not impressed. I'm definitely not impressed. I used to really like this company back then, mostly because the company was always growing through those acquisitions. So the key here is OpenText offers cloud-based services for enterprise. So enterprise data management systems. Basically, you have a business, you need to manage all kinds of information about your client, about your stocks, about your employees, and you will use those ERP system that OpenText provides that is based on cloud, and they will help you understand better your business, find productivity levers, and move on. And the key here is by growing by acquisition is not that you're just adding revenue, but the secret sauce here was to be able for OpenText to get new clients. So when you acquire a company, you also acquire this book of client, and then you can do some cross selling. So you have your own products, you're buying a new business with a new products with new clients, and then what you do is that you're using this new service that you just bought and you offer it to your existing client, and then you meet with your existing client, you meet with the new client, and you offer them your existing products and services. And that works very well. It is a playbook that has helped OpenText to generate amazing returns for several years, but now you're looking at the overall picture and it's not like that anymore. I mean, keep in mind, in 2018, the stock was trading at peak value in 2018. It was at $50, and today we're at like $41. So what's happening? Well, first, when I'm asking those kind of questions, I always look in terms of like saying, oh, it's a good stock or a bad stock because the stock price moves in one way or another. What I prefer to do is to look at the dividend triangle. So I'm going to forget about the stock price performance right now, and I'm going to focus on what is really going on. So what I see here is not that much revenue growth for a while, and then a big jump between 23 and 24. Which was related to the acquisition of Micro Focus. So again, for a few years, they kind of like almost stopped making major acquisitions, just like small here and there. And then they make a big one last year, which created a lot of commotion on the stock price among investors because they were not too sure they would be able to pull it off and generate more returns out of this. So far, so good on that side. But in terms of earnings, we have like very poor earnings per share. 5 years ago, before the pandemic, we were at like $1.20, and now we're at 95 cents. So not much growth here. Actually, not only like stagnating, but very difficult for the business to maintain their growth strategies and generate higher earnings, which kind of suck as well. And that probably explains why you had like a long period with not much revenue growth, and then you have like 5 years where you have absolutely no earnings per share growth, and then the dividend keeps on growing. The last the dividend increase in 23 was really small. This one this year, actually, this latest quarter was, I mean, decent, if we can put it that way. Not super impressive from a tech company, but 5% is still a pretty good dividend increase. I see it again. I kind of have that feeling that the company is becoming mature, offering like mid-single digit here, but the last quarter was not that great. I mean, it kind of like mixed feelings where earnings per share was up 8%, but revenue were down 9%, mostly because it counts the divestiture of AMC, and they're also shifting from the license-based revenue to cloud services. Why they're doing that? Well, because it's going to generate higher recurring revenue going forward, which I think it's a pretty smart move, where you can just count off that, like kind of like that utility bill business model where your clients are just paying the cloud every month or every year without asking much questions, and they're just getting that service, and that's all fine. So for the overall year, it was pretty good for that. The revenue was up 29%, mostly driven by acquisition, and annual recurring revenue up 25%. So we're not ready yet to say that OpenText is going to just become a mature and boring business, but we'll need more than that. Right now, they just focus on the cloud. It's great, good buzzword, it makes sense, recurring revenue, I all get that and I love it, but I will need more revenue growth outside of the growth by acquisition, because that is a problem that has been recurrent for OpenText for several years, is when they're not making a big move, their organic growth is not that impressive. Now we have a glimpse of hope, because OpenText management says that they expect a 5% organic growth from cloud revenue for fiscal year of 2025. But again, as I can say, from a technology company, we're starting to talk about some okay numbers, but not super impressive. So maybe it's not going to go back into this amazing model it once was. It's a bit disappointing, I must say, but it happens all the time. And this is maybe one way that you can like raise a red flag if you have OpenText in your portfolio, is to review the reasons why you bought it in the first place. So if you bought it for its amazing growth and aggressive growth by acquisition strategy, where they're doing that cross-selling I explained earlier today, well, maybe it's time to revisit your investment thesis. So those numbers are not there anymore. I don't have it in my portfolio, so I'm completely unbiased on this one. I don't like or dislike the stock. I'm a bit neutral. I used to like it. Now I'm a bit disappointed with the dividend triangle. The dividend growth rate has slowed down. Now maybe it's going to get back. Maybe they're trying to like revive the hype around this. But for a technology company paying like 3.5% yield, it's already telling me that something is going wrong. And when I look at the stock price, I kind of get why. There's also a lot of competitors out there, right? You have Salesforce, CRM, that is based in the US, that is so much bigger. And plus, they started to pay a dividend, so it will come on my radar eventually. I haven't looked at CRM yet, but I know it's a direct competitor to OpenText. And OpenText at 10 billion, I mean, it's great because they have like tons of clients. They're well diversified from that, but they may have a hard time to fight against bigger guys, especially because they're tech-related companies. And when you have like cutting-edge tech, or if you have like a lot of cash flow, you can buy that talent and build that cutting-edge tech as well. So I don't know. I see a lot of red flags, and this is not necessarily a company that I really, really like right now, mostly because their business models kind of change, and I'm not too sure that the mature business model will be a success. So, all right, Moose, I hope that you have enjoyed this podcast if you are looking for, I would say, better ideas, like companies that have actually a strong dividend triangle. I suggest that you go to moosemarkets.com/rockstars and download the Rockstar List. So the Rockstar List, it's an Excel spreadsheet tracking all companies showing revenue, earnings per share, and dividend growth positive over the past 5 years on both the Canadian and the US market. So moosemarkets.com/rockstars to download it. If you're already on our newsletter, every Friday we send you a reminder of where you can download the Rockstar List or the Dividend Income for Life guide. So if you're already on my email list, well, I want to thank you first for reading my stuff, and then I want to reward you with our resource page where you're going to be able to download all our guides and our other resources. All right, Moose, we're going to talk again tomorrow for Business Friday. And until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.